As a dentist, doctor, or small business owner, you're probably feeling the weight of balancing your demanding practice with your personal life, right? It's tough to find the time for family, to focus on your health, or even think about your financial future when you're always grinding away at work. To the Dr. Josh Cochran Show, where I'll focus on empowering professionals like you to build passive income and achieve financial independence through real estate and smart investment strategies. Each episode, you'll discover practical steps and real-world stories to help you create long-term wealth and gain more time to focus on what really matters: health, family, and freedom. You're ready to break the cycle and start living on your own terms. This show is for you. Good morning. Welcome to the Josh Cochran Show, #1 show for dentists, doctors, and entrepreneurs that covers wealth, health, family, freedom in the world. Brought to you by Cochran Capital. We have thoughtfully designed investment portfolios for accelerated wealth building, sophisticated strategies to defer or eliminate capital gains, depreciation, recapture, and ordinary income taxes. Build the future you deserve. And just a heads up today, everything we talk about on this podcast is just our personal opinions and experiences. We are not giving legal, financial, tax, or accounting advice, so don't take it that way. Be sure to talk to a qualified pro before making any big decisions. We're just here to share ideas, have real conversations, and hopefully help you think a little differently. We have a great show today. Dr. Faldet is back. And a little bit on the news before we dive into our topic today, which is going to be focusing on retail. I love that asset class. In the news, one interesting thing that I found was so the Fed is the key interest rate lower in the US, right? They control that. It's not something that Trump, the administration, controls. But one thing that is being done is deregulating the banks. And through bank deregulation, the hope is to decrease interest rates, both for buying homes or for investments. Like everything just does so much better when rates decrease. And so the intent here is to loosen the supplementary leverage ratio. Okay. This is like how much money the banks have to put in like certain places and just keep it there in certain asset classes that aren't maybe providing good returns. So what the regulators are hoping with these easing of capital rules will free up cash so that the banks could buy more treasuries, especially the 10-year note, which would increase demand for those, which would push down yields, which is basically lowering interest rates. So I know we all look at the Fed and what the Fed's doing, but I do want to say that the Trump administration is also looking to deregulate, and that's another way to lower interest rates and really, really help everybody out. So, any questions on that one, Reed?
No, I think you explained like the tactic there, but what's the downside if we're deregulating banks? Are banks
Yeah.
going to participate in some
I,
um
yeah, I mean, this is always the debate, right? How much should government be involved, right? If you don't have any government involvement, then it's just chaos, right? But if you have too much government involvement, nothing
cost?
happens. You essentially sterilize the entire industry, and there's no good return. The best analogy I heard on this was actually from Elon Musk. He was talking about like picture like a soccer game, okay? Or a football game, right? You have like a certain number of refs in the game, okay? Um, Actually, basketball is probably what I know best. So you got three refs on the court on basketball, right? And they found that's the best, right? What happens when government gets too involved? It's like having 20 referees on the basketball court.
Yeah, I'm
It's not
following.
fun to watch.
Well,
There's nowhere for players to move.
yep.
Yeah, it's not you've taken all the fun out of it, right? It's the same thing with government. You have too many refs on the field. You've taken all the upside out of something, all the like what it is at its core, it's gone. So it's finding that sweet spot. And so the Trump administration believes there's way too many refs in many of these industries, right? And you're going to miss some calls if there's not enough refs, right? You're going to miss a few calls, but that's part of the game, right? Overall, the game is much more fun, much more beneficial to society by minimizing the number of refs.
Can I take it one step further, your analogy? What if we
Sure.
do, no refs and everyone calls their old fouls like a pickup game? Then what does that look like, right?
It's
This the
not
players
good.
not good.
That's not good, right? There's
We're going
fights,
dirt
there's arguments, there's
almost in the face.
punches thrown. So
Yeah.
it's about having the right amount of regulation. So that's what they're working on is finding that sweet spot that helps grow production. So
Yep,
good.
I'm good.
All
I'm
right,
good.
Reed, you have a very talking in concepts is helpful, but talking in realities and through experience is even more helpful. And you made a couple posts this week about some of your projects in relation to retail. I found them very helpful. I would love for you to share those today and help our listeners.
Yeah, sounds good. By the way, you always fire a good nickname at me, so I have one for you today. Are you ready? Got I got cap rate Cochran, like that.
I like that. Capri
Or
Cochran.
the Wizard of Oz.
Talk to me about that one.
You're the opportunity zone guy. OZ.
Oh, I like it. I like it.
Yeah. Thought
Somebody else called me that the other day for something else, but I like the meaning there. The Wizard of Oz. Thank
Wizard
you.
of Oz. Yeah. So you can use that. I'll try to get some better ones as we go, but that's what I got for today.
No, that's good. All right, Reed,
Uh,
floor is yours.
well, I thought first we just quick touch on for people that don't understand because I'm always trying to think of like who are we talking to and who's going to be interested in the information. If you start too in the weeds, then people get lost and it just loses its like interest and relevance. And if you keep it too shallow, then you don't really get to pull any true value from it. Just like you're just talking about things. So finding a balance in there, but starting high level. Um, we're going to talk about like a retail property, which is like a retail strip center. We see them in all of our communities, right? Whether they're quick serve restaurants, whether they're dentists, whether it's, I mean, any type of service industry now tends to be more in retail sectors. So I thought we could just quick explain, maybe you could quick explain why you like retail and what a triple net lease is, and then we could go from there.
Okay. Do you want you to start and me to add color or vice
Sure.
versa? What would you prefer?
Yeah, yeah. So I can start, I guess. So uh most commercial assets, when we say commercial, retail, industrial, medical office, are considered triple net properties, meaning that the tenants pay rent, but they also pay a lot of the expenses or most of the expenses on the property. That's what that triple net and stands for. It's also paying maintenance, property taxes, and insurance typically. And so as the landlord or the owner of the property, you get to basically collect rent from the tenants, and then they're also paying your expenses. And so the math becomes a little bit easier to figure out what your cash flow is. And so these are very desirable properties to have if they cash flow well. And one nice thing about it that's different from multifamily or residential property is that you are leasing to business owners instead of people that are living there. And so your tenant is a business owner. And so typically you have a more sophisticated tenant. They tend to stay there longer. They're a stickier tenant, meaning you don't have the turnover that you would if you had an apartment building. And so there's a lot of benefits to that. There's also some risks. Mainly, I say that there's some concentration risk because you're more likely to have greater vacancy on a retail strip center than you will in maybe a 50-unit apartment building because it's just a matter of numbers, right? So you can have a couple people move out of an apartment building. If you have a couple people move out of a retail strip center, I mean, that could be 20% of the property or more. And we can kind of talk about that too. But I just wanted to kind of compare and contrast
Yeah.
family versus like retail triple net.
Yeah, I love retail because it's simple, right? It takes work on the front end to get it set up, to find the property, to make it look nice, to bring in the tenants. and maximize those leases, right? And by maximize, I mean get the highest rent you can as the landlord and get the least pain in the butt tenants possible, right? When we're talking about passive income, um, I found that retail, I'm sure industrial is probably similar, but I don't work in that asset class. It's kind of the most passive. And so I love that. And I also understand it, right? As dentists, a lot of the listeners here are dentists, like we understand what it's like being in a retail building typically or an office building, right? Either as a tenant or maybe we own our own building. And so it's super important for whatever asset class you work in is that you understand it. You understand it from both sides. And so I think retail is a great industry to be in. The hard part on retail is lending. There just isn't banks that will lend on retail unless you have a signed lease, and tenants don't want to sign a lease unless you have a building. So it's a catch-22, right? So that's I think maybe the number one challenge to overcome. And if you buy a building with tenants that are already in there, your returns aren't going to be great, right? You're not really adding value. It's just somehow you find this place. If it's on listed online, you're really not going to be buying it for a deal. If you get it through a relationship, maybe you can make money there. So um, yeah, so I think simplicity. That's probably why it's one of my favorite, and I get it. And it's kind of fun. I was talking to a guy actually right before this call who builds, who's doing a 7-Eleven right now. And you kind of look at the math, and if you can find the land, the right land that 7-Eleven wants, and you have a relationship with 7-Eleven, that's the biggest piece here, right? I think he's putting in probably 2 million into the project, getting the rest in debt, and then when he sells it, the numbers kind of look like he'll make 2 million, right? So put 2 million in, get 2 million out. So it's really about at that point, like how, like mitigating your risk, right? Making sure like everything's teed up there. And then two, how long does it take you to do it, right? If it takes you 18 months to do the whole thing, right? That's doubling your money in 18 months. I mean, that's pretty good.
But
That's a 66% return.
yeah,
Um,
say no to
so
that.
yeah, so it can be really lucrative. So, this is Reed's floor. So Reed's going to kind of talk about a project he's done, or maybe one or two, and he's got some great stories. So, Reed, let's hear it.
No, yeah, sure. So this is actually the first retail property that I actually bought. So and there's some, you always remember your first deal, right? Your first big deal, where you're basically emptying the coffers to buy it.
I
You're like, oh man, there goes all my cash. It's gone.
love it.
So a little background, this is a 30,000 square foot retail building with three tenants in it. And so when I bought it, most of the leases were around 5 years on it. But coming up this summer slash fall, I had roughly 24,000 square feet of lease renewals, meaning that the tenants were could extend an option or they would terminate their lease and then I would have this vacant space. And so vacancy kills you in any in the real estate game. But the key is to mitigate that risk the best you can. So we can't control whether the tenant stays, right? If there's things you can do, but if a tenant decides to move and it's just what it is, you got to kind of have to solve for it. And so, but with risk in real estate, there's opportunity. And so
Mhm.
as Josh was mentioning, if you were to buy a retail strip center and then try to lease it up, meaning it's vacant, there's risk in that, and therefore that's why it's hard to get lending on. And at the same time, if you buy a property with upcoming vacancy, right? Currently there's tenants in place, but maybe you're anticipating some vacancy, as in someone's going to move out. There's opportunity to release that property at a higher rate and then therefore drive up the value of the property.
Yep.
Um, but I wanted to just kind of risk and reward. That's what we do as investors. There's risk and reward. So just kind of laying those two things out there. So just explaining the risk a little bit. What would it mean if 80% of this property that I own is vacant? Well, as we kind of explained with triple net properties, you get rents, and then they also cover the expenses of the property. So if I have vacancy, I'm getting dinged on both not collecting the rent, but also I'm not getting to get the expenses paid for by the tenant. I'm gonna have to flip those myself. And of course, we usually use leverage in real estate. So I have a mortgage on the property. So what I kind of factored in on this, and I'll have to make sure I'll double check my math, but roughly, um, it's the expenses on the property, mortgage, taxes, insurance is roughly $31,000 a month. And so with 80% vacancy, that would mean that I'm going to have to come up with $22,300 a month until I get it leased up. So if you imagine what that adds up to month after month, or if you go 6 months or a year of vacancy, you're talking about $250,000 of cash that you have to put back into this property to keep it afloat. So there's your risk.
And with taxes, right? That's probably like 325 million you'd have to make, to pay the taxes and then pay that bill, right? Yep.
Yep. Not fun. Not fun.
Not fun.
So this is I think my tolerance for risk has been climbing because you find yourself in these situations where you're stressed and then somehow you come out the other side and you're like, oh, okay, I can do this again. And so you kind of maybe bad, but reinforces like how much risk you're willing to take on and what problems you can solve for. But this property specifically, I got enough notice on one of the tenants that I knew that they were going to leave. So I kind of had like almost a year heads up, 9 months heads up. They're a little back and forth. But essentially what I did is I negotiated with them to leave early if I found a new tenant so that I could get them to commit to leaving. And they were open to that. But it ended up working out fine where I could match the new tenant coming in. We started marketing the space at the same time they were leaving. And so virtually I'll have no vacancy, which is nice. So that's a big part of mitigating risk with these long-term leases is making sure you have a long enough runway or notice period that you
Yeah,
know a vacancy is coming up and you can start to try to backfill it.
absolutely. Can I ask you a question on this one?
Yeah.
This is actually the question that popped up when I saw you share this. How did you market your space?
How did I market that we're going to have a vacant space?
Yep.
Just through a broker, through a local broker.
Okay, so you did go through a local broker, had them, did the new tenant come from the broker relationship, or did the new tenant, like somebody they already knew who was looking, or did they list it on like Crexy and the service, and then somebody who was foreign to both you and the broker, end up renting it?
It was someone both foreign to the broker and I, but it's a secondary market. And so the networking of the local brokers, I mean, you tend to know that if
Yep.
it's a smaller market, they tend to know who's looking and who's not. And so to back up, I have a property manager, a professional property management company that manages its property for me. They have a brokerage arm. And so I always start there because I have a prior relationship with them. And I've asked brokers underneath this property management company questions in the past, right? Like, can I get comps on this? And they've always been really helpful. And so I've trusted and leaned on them in the past. So this specific broker named Dina was the one who was like, yeah, I already have some people in mind that I could, potentially this could fill the space. I've already showed it to a couple people. Like, so she was familiar with the property already. She already had some potential tenants in her back pocket that she could market the space to. And then on top of that, they'll send it out into like a Crexy. So I'm not leasing or I'm not listing it myself. They're marketing the space. In doing so, I would pay them a commission upon signing the lease. So
So do you feel like at the end of the day, the broker, could you have just listed it on Crexy, on LoopNet, on the neighborhood app, and found a tenant and done it yourself?
Mhm.
Or would you have not gotten this tenant if you hadn't hired a broker?
I don't know. I don't know if that's a good question. I'm not sure. But what I realize is I don't have a lot of time. And so having a broker that specializes in this, like I don't do anything that someone else can do, which is like my motto in life about efficiency. And so if I can get someone else to do it for me who already has specialized knowledge and can do it twice as fast and tap their network, I'm going to go that route, even if we have to pay them in commission. It's kind of like not hiring a hygienist because you don't want to pay them. You're going to just clean teeth. Like it doesn't make sense. The ROI on time doesn't make sense to me, but you could.
Yeah. I'm bringing this up because this is like a choice everyone has to make, you know. I feel like the people who really like it and lean into it, right? They like filling up buildings and they like being that person that goes out
Mhm.
and does it. I think it makes sense. I think if you're like in your situation where like, dude, I have no time. I got my dental practices, I got this other stuff I'm doing. Like, I'm happy to pay somebody to do it. I think then that's the right decision, right? So if you're not really gonna dive in and do your best, hire somebody. But if you feel like, hey, this is something I enjoy, um, on leasing stuff. I mean, with AI now, you have like other brains looking at the leases. You can totally do it yourself if you decide um, that's
Or,
something
or
you're excited
or
about.
if you have a spouse or something that can do it,
Yeah.
that has the bandwidth to do it too. I mean, you do. You save yourself commissions on that. Um, but I always think to myself, like, would I want to do that job full time? Would it pay me well enough to do it? And if it wouldn't, I'm not going to do the job. You
Yeah.
know, that's kind of how I think about it too. But if you have a lot of time on your hands and maybe you're retired and it's kind of a fun pet project, like you said, then it's not a matter of return on time. You just have the time and you enjoy doing it.
I think outside of dentistry or medicine, whatever you're doing for practicing, I think you can only really have bandwidth to get good at like one other thing, right? And so if you decide it's like, okay, I'm going to buy retail buildings or build them and then I'm going to lease them, you could probably get good at that. But if you're like, I'm going to do this and I'm going to do this and I'm going to do this, that's when it's like, yeah, you're probably not going to have the time and it, yeah. So,
And
okay, cool.
you can be very mediocre at a lot of things.
You'll be very mediocre. Well said.
Yes.
Okay.
Yes. So let's see where we were on that. So I got the one space basically leased up, and the other one was a bigger space, roughly 19,000 square feet. And this tenant is has a lot of build out in the space. It's quasi retail, quasi manufacturing. It's a distillery with a retail component, and so there's a lot of build out in the space. And he requires quite a large footprint to operate. Um, and so he was basically telling me, I've kept an open line of communication with him. Here's one thing I do. So even though I have brokers, I cut right to the tenant a lot of times because I'd rather just have that personal relationship with the tenant. When it comes to negotiations, everyone's more transparent and cordial. Sometimes brokers can muddy the water if there's already, Josh, you feel that way or?
100%, dude.
Yeah.
Yeah, I mean, I could tell you a story. I'll let you finish. I'll tell you a story recently that happened.
Yeah. So anytime I feel like negotiations are getting contentious and there's a broker, I ask for whoever the person is I'm negotiating with. I get the broker out of the way and I go right to them because it almost always is better. They talk to me on the phone like, okay, this isn't some king in a castle that's like, you know what I mean? I don't, not that that's the perception, but sometimes it is. It's like the landlord is this mean, shrewd business person. And then when you talk to them, they're like, okay, this is just another person. And they're just talking to you. And then you can just work it out. So
It's so
that's what
much
I found.
better.
It's
Yeah.
better.
I give them a leash, the broker, right? If things are moving quickly, right? We receive an LOI, a letter of intent from a tenant that wants to be in the building, right? I let the broker do like the first step, like um kind of call the other broker or the tenant and chat with them a little bit and negotiate terms. And I do that a little bit with the broker. If things are moving forward quickly, I let it go. Right. This is like allocation of time, right? Like just like you talked about. If things aren't moving forward quickly, then I get involved. So the last LOI we got was a good company. It fit the building, like the building mix was very synergistic. And so I was like, oh, this looks pretty good. So they went back and forth with the brokers a little bit, but then things just kind of like started stalling.
Yep.
And my broker is like, I don't know, with the la. And I was like, okay, well, let me just call these guys, right? So I just called like the head of the company, like the CEO and the CFO. I got a hold of those guys. And I was like, hey guys, like I got this building out here. It's great. I think it fits your guys' model. You guys did an LOI and things have just kind of stalled. Like, are you interested or are you not interested? Like, doesn't matter to me. I mean, it matters to me, but it's fine either
Yeah.
way. But they're like, I need to know, right? And they're like, yeah, no, we totally interested. La la la. We're like waiting for this, and I'm like, what do you mean you're waiting for this? So like, waiting for this. I'm like I've talked to my broker, and they're like, no, we told our broker, right? And so you're just like, there's no reason this is stalling, right? This is like communication issues, and you got to
Mhm.
remember the brokers are always following the money. Okay. And brokers aren't like, all of them aren't on top of this. They're basically in the relationship business, right? And so there will be brokers that are deprioritizing this compared to their other stuff, deprioritizing this compared to their golf tee times. Like this broker doesn't mean just because they're a broker and they're going to get paid potentially doesn't mean they care like you care.
Yep.
Um, and so what we found out actually, like my broker on this one is actually like super intense. He's like high energy, like top broker in the area. This guy's on top of things. He dots his I's and crosses his T's. So I didn't really worry about him, but it was their broker.
Mhm.
I don't think he has a lot of experience. I don't think tenancy is what he's used to. He's used to selling things. Like he was the problem. So basically, yeah, besides pushing paperwork, I went direct to the CEO, CFO, and then they have a project manager. So I ended up talking to the project manager. Most of these companies have like a project or program manager that kind of handles this stuff for the executive team, and that's the who. And we got that done, and we knocked it out in like a week, right? And it had been sitting quiet for 5 weeks.
Yep. It's I can piggyback off that just a little bit. There's
Yeah.
with this specific tenant, it's a physical therapy wellness type tenant. They're
Mhm.
doing a pretty good build out. They have a couple other locations. So their broker is kind of known. So it's the buyer rep or the leasing rep broker, not my broker, and you have to deal with two brokers that are standing in between you and the tenant. And so there's
Yep.
quite a bit of space there, which is how some people want it, but that's where it gets messy. And this broker basically was like negotiating her commissions and said she would kill the deal if she didn't get her. And I'm just like, what? That's so unethical. It's so unethical. You cannot do that, right? And it's like,
Nope.
so there's that kind of stuff. You have to know, you have to know the incentives. You got to know how they play the game. You got to know like some people, whether whatever industry you're in, are good people, and there's some are not such good people. So yeah, you learn a lot just by transacting. That's for sure. So where was I with the numbers? I guess I'm trying to. We talked about.
Yeah, we kind of go on these side
Okay,
things. So yeah,
so
you brought in this tenant to replace the other tenant, and I think the numbers were better actually than the previous tenant, right?
yeah, it was like a $2.50 raise per square foot, which is really good. We were going from 12 to 14.50 a square foot, which is a pretty good jump. Um,
Out, did you have TI costs?
yeah, but pretty insignificant. I think 49,000 or something like that was the TI I was going to put in. Well, they're going to put $250,000 into the space, and I'm going to add 50. It's like, yeah, the ROI is good. I'll take it. Um,
Yeah.
so that was good. And then the other tenant, and I'll talk about the economics of that too, but the other tenant was the bigger one, like I said, the retail with distillery. So it's a larger footprint, larger tenant. It'd be a little bit harder to fill the space, but I could also divide the space up if I needed to. But I going into that, I always get a sense of what we have as a supply within our market, so I know how hard to negotiate. So like basically, I want to know, can they move somewhere else? Where can they move to? Could they develop something? Like, so I know like what are their options? And if they have very few options, I have more leverage. I can push harder negotiations. So that's basically the gist of it. The tenant came to me and and at first when he came, he's like, hey, I'm gonna leave. And I'm like, ah, shit, this is gonna suck. I don't want to have to pay for these massive build out costs and 6 months of vacancy or whatever it would take to backfill the space. But after doing my market research, talking to the brokers, talking to multiple brokers, they're basically like, this guy has no place to go, right? And if we need to, we can backfill that space probably in 6 months and get you a higher lease rate. And I'm like, okay, so I'm gonna do just fine. If he decides to leave, I'll be okay. And so there, I'm gonna push pretty hard, and I did. And I drew my line in the sand. I said, this is what I want. If you don't sign it by this time, I'm gonna start marketing the space. And he signed, and we're good, and we're moving on. So
This is a
Uh,
key point, and this is a good example because this happens, right? They're trying to negotiate, but for them to find a space, sign a lease, finish their tenant improvements, right? That that's probably a 9 month process. 9 months, right? And so if they're trying to hold your balls to the wall at 6 months or 5 months or 4 months before their lease is up, even if there was another space, it would be very hard for them to get all that done, right? Which means there's operational risk, like a dental office. Let's say your dental office does 10K a day. You don't want you're going to do a little TI improvements or something. Or you always tell the contractor, like, it cost me $10, 10,000 a day to be down. Like, I want you to do your work in the evenings or weekends, right? It's the same concept for this tenant, right? If they're a distillery or something, they can't. If is it a distillery or is it like a bar and grill or both?
both.
Both. Okay. So on the distillery piece, right, they have suppliers. They have to give their stuff to the distributor, right? So they need to build a big enough supply there. But on the bar and grill piece, right, they have employees and stuff, right? And so they can't like shut down their bar and grill. It's a major disruption to their business. It's very expensive, right? So you know this, right? Someone comes to you to negotiate. What you did was you identified your downside risk, got very comfortable with your downside risk, understood their position, like reality, what it would look like to move, and you knew it was massively painful for them to do that, right? So, I think this is a key point. Some people just get afraid of things, and the key point here is to do your research. Don't get afraid of things, understand things, and then act based off of that knowledge. Great work, Reed.
Yeah, thank you. It's not, you learn to do this from having been in these situations before
Yeah,
multiple times. Just reps, just like anything, reps.
it's
And
reps.
yeah,
It's
and uh,
reps.
and I think we're poised as dentists to do some of these things because we're very good researchers. We're really good at analyzing data, right? Just a
Yeah.
matter of posturing and applying that leverage when you can. And you learn how hard to push and how hard not to push. I pushed too hard before. I made a comment about that in that post too, but I pushed so hard on certain companies and that I get their in-house legal that are just coming down on me with you're gonna have to pay these damages if you hold this up. And just I learned like, okay, that was too hard. I pushed too hard. I saw the opportunity and tried to take it. So without getting into it, right? It's I've spent more on legal over the last 2 years than I ever thought I would in my life. And it's good though. Not from like a terrible standpoint, but just you realize that that's a part of it as well.
Yep.
Yeah.
Absolutely. It's
Yeah.
it's expensive. we could do a whole webinar on like negotiating contracts with attorneys. Uh, right? Like all these people you hire, accountants, attorneys, like their fees, like if you don't have good, solid structure in place, your legal bill can be 5 times what you think it's going to be, no problem, right? You think it's going to be 20 grand, it could be 100 grand, right? I mean, that's very likely to happen with certain law firms if you're not focusing on structure on the front end.
They're
Huge risk.
they're Yeah, it's billable hours, right? That's how they make their money. So they're not incentivized to do things efficiently at all. So, I mean, it's like that's the whole point. I'll go back to leaning on a broker is I lean on my broker. I'm like, generate the lease for me, right? Or generate the lease because I'm not going to go to my attorney who's going to charge me hourly when the broker is going to charge a commission, right? She's getting paid her
Yep.
commission. He's getting paid her
Yep.
commission. So I'll sometimes have my attorney review it. But story here is I generated a lease, had my broker say, yep, this looks good. I said, hey, can you just look this over and just rubber stamp it, make sure I'm not missing something. They rewrote the lease. I was so mad, right? And I was like, what was wrong with it? Well, I thought maybe this, or I thought like, no, it should have just kept, I'm gonna
Every
go,
time.
eh,
Every time. What was your bill on that lease?
I mean, maybe $1,500 or something like that. Nothing crazy, but
Same crap, dude. Last one I got, like literally, I used this attorney, and they're like, okay, we're gonna put this lease together for this building that we can use it in the future, right? I'm like, okay, you work with my broker a lot. You seem like you're type A type person, right? Dot your I's, cross your T's, very anal, right? Like, I'm like, okay, great. Detail oriented. We do it, right? We go to do the second lease, not the second lease with her maybe a year and a half later. She's moved legal firms. The lease she created for us at the first legal firm doesn't, she can't take it with her to the second legal firm. She's asking me for the lease,
Oh
right?
God.
Because she can't take it with it. And then B, she charges like 4K.
Oh my gosh.
I'm like, you are not actually adding value, right? For your, you're just billing in a very inefficient way,
Yep.
right? And this is the story with all attorneys, right? And so if you understand that, then you're going to build your lease in AI, right?
Yes.
You're going to
Yep.
ask AI to explain all the lease to you, right? And then you still have fear that you're missing something, right? So what you did, you put it through two filters. You put it through your broker filter first. Brokers are most are not detail oriented, right? So who knows if they're even going to look at it, but maybe they will. Maybe they do what they say they're going to do. Brokers usually just follow the money, right? So there's not a huge paycheck attached to it. Yeah. And then your attorney, it just gives you peace of mind, right? And usually you have them redline it, right? So now you see like what did they actually come up with, and what they came
Yes.
up with, did it actually benefit you, right? Or is it just more like they were just doing it so
Moving
they
words.
show they have value, right? You got to get a sense for that. Uh, I'm more and more again, it's always that balance of it's do you want to pay someone to do it or not? But with
Mhm.
AI, I'm more and more into just doing my leases myself.
Yep.
Yes, you can get screwed. Yes, you can miss something. If other people are involved, I'm not the sole owner. I will bring on an attorney to look at it. But if I'm the sole owner, I just tend to go AI more now, because I have enough experience, I guess, too, right? That I feel like you got to know what you got to know what you don't know, and I've kind of been through that enough now. I don't know. What are your thoughts? I mean, you built this one in an AI. Are you going to have the attorney review it next time?
I mean, that's the thing, right? You build it once and you have a template forever once it's approved once. So now it's as long as the patterns or the same type of lease is going to exist on the same property or other properties, then it should be fine. So you know, I'll probably have an attorney review, but I'll be like, hey, can you just spend 1 hour reviewing this, right? Put a guardrail on it so they can't go crazy. Whatever just that's what I would probably say is like my new filter going forward is this is how much time I want you allot to this. Tell me what you can tell me in 1 hour, and that's it. Then I have my security.
It's crazy. I'll have attorneys send me leases in Washington, and it'll say Texas 5 times in the lease.
Oh yeah, yeah. Errors that are there. Yes.
Right? It's like if this is their level of detail and orientation, they didn't even change the state correctly, right? Like,
Yeah. Or your name. My name will be
or
spelled wrong or something. Yeah.
you're like, how detail oriented are these guys really, right? Uh, yeah, and there's multiple AIs, right?
Mhm.
You don't just have to run it through one AI. You can build it in one, right? Build it in ChatGPT, send it to Gemini, right? Get that feedback, send it to Grok, get that feedback. It's like having three attorneys.
And yeah, almost perfection by that point. You can't get a higher level of scrutiny than that, probably.
Yeah.
Yeah.
Um, did you want to kind of wrap this one up? What were you
Yes. Sorry.
thinking?
Okay. So I'll go back to the basics. So got two new leases signed, so avoided the 80% vacancy, right? Good. That's good. I don't have to come up
Good.
with $250,000 over the next year to handle the property expenses and everything there. All right, so that's good. So what does that do? So not only did we mitigate risk, but now we actually added value to the property because our new leases are at a higher rate than our old leases were. So this is a good thing. But triple net properties, the expenses again should stay the same because you're passing those back on to the tenant. So essentially, any additional rent increase is going straight to your bottom line or profit on the property. That is known as your NOI, net operating income. That's what we all talk about in real estate. Yep.
And
And
your
so,
only costs of retenanting are typically broker fees.
Yep.
and tenant improvement dollars you hand out. Those are the two main ones not to forget. Yep.
Yes. And I didn't, in one of those, the renewal, there's no broker fees because I did that myself, right? Essentially.
Depends on the broker.
Well,
Make sure to look for that in the broker contract. Yeah.
yeah, yeah. But the other one I will have to pay a small commission. It's nothing crazy. So I guess we can factor that in too. But all right, so we added essentially $31,000 of net profit to this property per year. So this property already cash flows like 130 grand a year. So I just added another 30 grand. So now cash flows about 160 grand. That's
Yep.
after debt service, right? So mortgage is paid for. That's how much I take home with this property. But that additional $31,000 in revenue adds almost $400,000 in value to the property because commercial real estate is valued based off of cap rates. And the going cap rate for this type of property in the area is around an 8% cap rate right now, based on the brokers I've talked to. So um, basically, just like with your dental practice, it's multiples of EBITDA. Commercial real estate, it's cap rates and NOIs. NOI is your profit or your EBITDA essentially, and your cap rate is your multiple. Just an inverse of your multiple. So you take your increase in net, which was that 31,000, you divide it by the cap rate, which is 8% or 0.08, and you get the new value increase, which is that 393,000, I think is what it came out to be.
It's really good. Let me ask you another question, another way to look at it. What do you think broker fees and TIs total that you gave for these two leases?
Let me, so if it's 70, that's a good question. Times 7 times 0.0. I'm gonna just quick do here. I think brokers fees are gonna be around 35,000 and TI was right at 50.
So 85. Okay. And how long are these leases?
7 and 5.
7 5 years. Okay. So the way to think about this is just like purely an investment. Um, Reed invested $85,000 today. Okay. And then each year he gets $31,500. Okay. So in about 2.5 years, he's gotten all of his money back. And then everything above that is pure profit.
Mhm.
And he's got 1 5-year lease and 1 7-year lease, right? So as long as these companies don't go bankrupt, this you can run the return on investment numbers, and you're going to find it's quite good. So so that's why you're willing to spend the money up front, because you're getting this investment money back. And when I say investment, it, all the active work is what Reed already did. On the day to day over the next 5 to 7 years, Reed is is very little involvement directly with these tenants, right? I might talk to my tenants once a year, right? They have like a question about something, and if it's management wise, I just say, hey, the property manager's Jason. He's great. Here's his number. Call him, right? Not my problem. Supportive, but not my problem, right? Like he's great. That's what his job is. But sometimes they have like bigger picture questions, right? Like one of my tenants wanted to add a service that another tenant was offering. And
Yeah.
you try to protect your tenants, right? You don't want them to overlap. And so, but I listened to the tenant and I said, hey, this is a major large corporate tenant, probably one of the largest employers in the area. So, you really want to take good care of them. So I was like, hey, let me connect you with the other tenant. And you guys might be talking like apples and oranges here, right? The services may not be in conflict, right? It might even be synergistic. Like two parts of it was like a therapy, right? Occupational therapy and physical therapy, right? It's like, are you guys actually complementary and not contradictory, right? So, so those are the types of things you do. It's just very little, right? It's kind of fun. You're helping people. That's why retail is so helpful, right? If you in multifamily, even though you have a property manager, you're often the asset managers kind of managing the property managers, or maybe you have an asset manager too, but like, you get involved sometimes when like somebody slips and falls, right? And or somebody gets hurt and there's like an insurance claim, like the party, there's some more involvement there. Yeah, so I think the worst is single family, right? Or Airbnbs. Then you're like, it's a
Nightmare.
job,
Yeah.
right? So multifamily is way better than that. But I think retail is just so attractive. Like you said, it's the corporate tenants. You get things set up on the front end. If you're just doing the leases, or if you're doing a value add, you just clean up the building, make it pretty, go find tenants, right? Figure out what they want, serve them. And then it's really passive after that. It's a great thing for people. So
it in the net worth aspect of being able to do not that many hours of work, right, on this to yield an essentially a $400,000 increase in net worth. I mean, you start doing the ROI on time there, and this was the second one I've done this week of something similar, where like the trash one. I made that post about the trash.
yeah, same idea.
Same idea. Just we added a cut of the expense of 31,000 and the same valuation.
So what people get stuck on is they're like, oh, I heard like RVs are so good, or I heard like self-storage is so good, or mobile home parks. Like the market corrects itself, right? And so if self-storage is really good for 3 years, by the time you've heard of it, learn it, implement it, it's no longer the best asset class, right? So the number one thing here is educate yourself, right? Books. I launched a mastermind read this week.
I saw it posted.
I was just like, okay,
Yeah.
I can't do these posts like little quick answers. It's not really helping people, right? So I was like, I'll just do a mastermind. We'll see how it goes. But like learn from others, right? Like you got to do the learning. Learn from others. Read books. You know this. I'm preaching to the choir, but it's just telling the listeners. And then you got to do, right? And that's how you learn and get good at things is doing the research, but also the doing. Um, I don't even remember where I was going with this.
Well, you gotta pay to play eventually. I say that, right?
Yeah.
Like
Oh,
you
yeah.
go ahead.
Okay, asset class. So
Oh,
it's learn about an asset class,
oh,
right?
choose an asset. Yes.
Do the asset class, and then
Yes.
you're gonna figure things out like doing your own garbage or negotiating with the garbage. You're gonna find the ways to get asymmetric, inordinate, like higher returns than average, right? You're gonna figure that stuff out over time.
It,
So that's the key. Any asset class you can be successful in, but just choose one and get good at it.
that's
So,
good. Good advice. I probably haven't followed it because I have industrial, I have retail, and I have multifamily, right? But it's I started in the triple net space, because it seemed easier and more to manage, and then I've evolved into multifamily. But the pattern recognitions I picked up doing, triple
yes.
net commercial, and then it just you see the patterns of it, and then it just realized that it's similar. It's a little different verbiage, it's a little different language, but it's roughly the same game.
It's synergistic. So there's always that. This is a gray area, right? Master of none, or jack of all trades, master of none, right? There's a sweet spot in there where things are synergistic, where you can do a couple things, right? And it all kind of works, like developer, I'm a developer, right? I find a great piece of land. Sometimes it's affordable housing, sometimes it's multifamily, sometimes it's retail, sometimes it's both. Sometimes it's retail in the front, multifamily in the back, right? And if you don't understand that both, you don't see the synergy there, right? You
Yep.
don't understand, oh man, it's 10 acres. If it was 2 acres, I could do a great retail thing. Okay, great. I guess I got to pass on this one, right? But
Yep.
because you understand both, right?
It's
Um, so I'm with you. I do a few things, right? Because I see the synergies. But I'm not in mobile. I'm not in industrial. I'm not in RV. I'm not in self-storage because it just hasn't been synergistic with what I'm doing already, right?
yep.
Industrial somehow was synergistic to you, or an opportunity just fell in your lap, and that's probably how you got involved, right?
I'll say this then. This is how I kind of view it is
Yeah.
you have it's different tools in the tool belt, right? But if you don't know how to use all the tools, you can't really wield the tool. So I mean, that's all I kind of, if you have a couple, like you said, if you have a piece of land and you know retail and you know multifamily, you have two tools that you can possibly use to make that piece of land work. If you only have one, you can't, you can only do
Yeah.
one. So there's that certain element. But also what I think of is I can lean on my specialist. Like I know people who are heavy in industrial that know more than I do. I know people who are heavier in retail. Like if I was it underwriting a property and I was like, ooh, something's not right here. I don't have great confidence. I can go to Josh because he's gonna be tell me like, hey, you missed this, missed this, missed this, right? Like focus more on this. Um, if I know people to talk to who uh have $1 billion of multifamily that they asset manage for, right? Like I could ask an asset management question to them. So like even though I am maybe not a specialist, I do have resources at my disposal to find the specialist to help me within that thing.
I think that's important, right? If you know you need to know just enough about the different asset classes, right? That you're like, you know what? I think this is what needs to happen here. And I know the who that can help me because I can't be that good at this many things.
Yes.
I agree with that 100%. Um, lean into what you know.
Yeah.
Yeah. Okay.
Yeah.
Well, our episode today was we wanted to talk about retail a little bit and give a real life story about what retail is really like and how to be successful in retail. And I think you did fantastic there. I think the other point here we want to talk about the other lesson here is the it's not about the asset class, it's about you and your team getting good.
Yes.
You can get good at any asset class. So follow your passions, follow your opportunities.
Mhm.
Any other key take homes from today that you wanted to wrap up?
I don't think so. No, I think we covered everything pretty well. Just to it's good to see just case studies and understand these things and see how they might work and start picking up on the patterns of it. And eventually you might see an opportunity in your market. You're like, I might want to look at this a little bit closer because here's a chance to get that asymmetric return on time or money or whatever. So, and then just find the people, if you don't know how to do it, find the people who do know how to do it and they can help you. Whether they partner with you, whether they just give you a little advice, you know, I love partnerships and collaboration. I mean, that'd be my final summary point is look for good partners or good collaborators.
Yep. Yep. And it's nice in about partnerships in real estate versus dentistry. A partnership in dentistry, it's like your practice, it's like your home. It's like a marriage. In
Marriage,
real
yes.
estate, you're like marrying on like a piece of property, right? And a lot of that can be property managed. So it's more like committing to go on vacation with another couple or something, right? Like, hey, it
And
might go great. It might be like, hey, that was the one vacation we'll ever take with this other couple. But it's not like, asking somebody else to move in with you or something.
you
So
still have to set expectations, right? No swinging when you're on vacation with that other
yeah,
couple. Just
yeah.
set those
Just get,
boundaries. But
just get real clear what the expectations are. Oh, all right. Well, Reed, it's always a pleasure, man. I love how you analyze things. I love how your brain works. Like I've said before many times, just knowing who you are on an integrity level, knowing who you are on your analytical side, right? You're going to be successful in whatever you decide to do in life. So I appreciate you coming on and sharing today. So thanks for everybody for tuning in to the Dr. Josh Cochran Show, Wealth, Health, Family Freedom. This year, commit to building the future you deserve. Take care.